Psychological price barriers are significant round numbers in financial markets. These include values like $1,000, $10,000, or $70,000 for various assets. They tend to act as strong resistance or support levels for prices. This phenomenon is driven by collective human perception and trading behavior. Traders often place orders at these round numbers, reinforcing their significance. These barriers reflect the influence of human psychology on market dynamics. Market behaviors are often influenced by factors beyond fundamental valuations. These influencing factors are frequently rooted in cognitive biases. A common bias is anchoring, where investors fixate on specific numbers. This anchoring often occurs around easily memorable, round figures. Such biases can create artificial barriers in market expectations and decisions. Bitcoin's price movements are often influenced by key psychological levels. The $70,000 mark has emerged as a significant psychological resistance point for Bitcoin. This level indicates a price threshold where selling pressure historically intensifies. At this point, many investors are inclined to sell their holdings. This increased selling activity prevents the price from sustaining higher values. Overcoming such resistance levels is crucial for Bitcoin to achieve new price highs. Historical market data reveals recurring patterns in Bitcoin's price movements. Bitcoin frequently encounters psychological resistance at significant round numbers. Examples include price points such as $10,000 and $20,000. These resistance levels often reflect collective investor sentiment and trading behavior. Despite initial resistance, Bitcoin has historically demonstrated a tendency to eventually break through these barriers. Bitcoin's price action often reveals significant resistance levels. A key example is when Bitcoin approaches a specific price point, such as $70,000. At or just below this level, a large concentration of sell orders emerges. This aggregation of sell orders forms what is known as a supply wall. The supply wall acts as a barrier, absorbing significant buying pressure. This phenomenon indicates strong selling interest and potential price reversal or consolidation. Investor sentiment analysis assesses the collective mood or attitude of market participants. A concentration of sell orders indicates a shared belief among many investors. This collective action suggests that a specific price point is deemed favorable for profit-taking. It also reflects a decision to reduce exposure to a particular asset at that valuation. Such patterns reveal market psychology and potential future price movements. Retail traders often exhibit emotional responses in their trading decisions. They frequently rely on simplified heuristics or mental shortcuts to guide their actions. These traders are particularly vulnerable to psychological barriers, such as round number thresholds. This susceptibility can lead to increased selling activity as asset prices approach these psychological levels. Institutional investors leverage psychological price levels in their trading strategies. These levels are used for strategic order placement, not just acknowledgement. They often set large limit orders around these key psychological points. This allows them to accumulate or distribute assets effectively at desired prices. An order book visualizes pending buy and sell orders for an asset at various price points, near significant price levels, such as $70,000. Specific patterns often emerge. A notable increase in sell liquidity indicates a large volume of sell orders concentrated at that price. This concentration creates a strong resistance, making it challenging for the price to rise further. Substantial buying volume is required to absorb these sell orders and allow the price to advance. Market depth refers to the total volume of buy and sell orders at various price levels. A resistance level is a price point where an asset's upward movement is halted due to selling pressure. Increased market depth at a resistance level indicates a significant number of sell orders. These sell orders represent existing supply from sellers at that specific price point. To overcome this resistance, a greater volume of buying demand is required. This means more buyers must be willing to purchase at or above the resistance level. A failed breakout occurs in financial markets when an asset's price attempts to surpass a key resistance level. For example, the price might briefly move above a predefined threshold, such as $70,000. However, this upward movement is not sustained. and the price quickly retreats below the resistance level. This retreat indicates insufficient buying momentum to maintain the higher price point. A failed breakout often signals a potential reversal or continued consolidation within the previous trading range. Failed breakouts occur when a price movement beyond a resistance level is not sustained. Traders who bought into the perceived breakout are then forced to sell their positions. This selling pressure often triggers stop-loss orders placed by other market participants. The activation of these stop-loss orders leads to a cascade of further selling activity. Consequently, failed breakouts frequently result in a significant increase in market volatility. A rapid market reversal can trigger a liquidation cascade, impacting leveraged positions. Leveraged positions are highly susceptible to sudden price movements. As prices decline, these positions are automatically closed to cover losses. This forced selling further intensifies the downward pressure on asset prices. The cascading liquidations create a self-reinforcing short-term downward trend. In market dynamics, a psychological barrier represents a price level that proves difficult to breach. Repeated failures to surpass this level can significantly impact market participants' confidence. This erosion of confidence leads to a collective perception that the barrier is insurmountable. Such a perception can cause traders to adjust strategies, reinforcing the barrier's strength. Consequently, the psychological level becomes a temporary, yet formidable, resistance point. A price point, once decisively broken, can transform its market role. For example, if a resistance level, like $70,000, is breached and sustained, it can then convert into a new psychological support level for the asset. This means that buyers are likely to intervene and defend this price point. Such a level indicates a strong area of demand, preventing further price decline. Traders meticulously monitor trading volume as a key indicator in financial markets. Volume analysis becomes particularly crucial when asset prices approach significant resistance levels. In this scenario, the price is nearing the critical threshold of $70,000. A strong breakout above such a level signifies a decisive move by market participants. For a breakout to be considered robust and sustainable, it typically requires exceptionally high trading volume. High volume confirms strong conviction behind the price movement, validating the breakout strength. Technical indicators are analytical tools used to forecast price movements in financial markets. They are derived from historical price and volume data, providing insights into market sentiment. Key examples include the Relative Strength Index, RSI, and Moving Average Convergence Divergence, MACD. These indicators help identify conditions such as overbought or oversold markets. An overbought condition, for instance, near a price of $70,000, suggests potential price reversal. Traders monitor these signals to make informed decisions about market entry or exit points. Funding rates are a key metric in derivatives markets, particularly in perpetual futures contracts. They represent periodic payments exchanged between long and short positions. These rates help keep the contract price pegged to the underlying asset's spot price. Positive funding rates indicate a dominance of long positions, while negative rates suggest more short position. Extreme funding rates can signal excessive positioning, leading to potential market volatility. High long positioning may precede a long liquidation event, while high shorting can lead to a short squeeze. Open interest in futures contracts indicates the total number of outstanding contracts not yet settled. It provides valuable insight into market sentiment and potential future price movement. A significant increase in open interest, especially near a key price level like $70,000, is noteworthy. This surge suggests a buildup of speculative bets, indicating strong market conviction or anticipation. Macroeconomic factors are significant external forces impacting financial markets. These factors include broad economic indicators such as interest rate changes. Inflation data also represents a key macroeconomic factor. Such economic shifts can profoundly influence overall market sentiment. This sentiment, in turn, affects the performance of assets like Bitcoin. It can impact Bitcoin's ability to overcome significant resistance levels in its price. Regulatory developments significantly influence market dynamics. particularly in the cryptocurrency sector. These regulations can exert considerable pressure on price action around established psychological barriers. Such barriers represent key price levels that traders and investors perceive as significant. Regulatory news can either reinforce the strength of these barriers, making them harder to breach. Conversely, regulations can weaken these barriers, leading to potential price breakthroughs or decline. Market structure, particularly around specific price points like $70,000, is inherently dynamic. This structure is in constant flux due to the continuous placement of new orders by participants. Existing orders are also frequently filled or canceled, further contributing to market evolution. These actions collectively reflect ongoing shifts in both supply and demand within the market. The interplay of these factors drives the continuous evolution of market structure. Price discovery is a fundamental market mechanism for establishing fair asset value. It involves continuous interaction between buyers and sellers in a dynamic environment. This process reflects the collective assessment of an asset's worth by market participants. The struggle at a specific price point, like $70,000, indicates active price discovery. A sustained move above a specific price point, such as $70,000, indicates strong market momentum. Achieving this typically requires a significant catalyst to drive demand and investor confidence. One such catalyst is a major influx of institutional capital, signaling large-scale investment. Another is a substantial positive shift in the overall market narrative, influencing sentiment. Psychological price barriers are temporary hurdles within broader market trends. These barriers often represent round numbers or significant price levels that traders perceive as important. They can lead to short-term market consolidation, where prices trade within a narrow range. Such barriers may also trigger temporary reversals in an asset's price movement. However, these psychological levels do not inherently define the long-term trajectory of an asset.